And good afternoon, everyone. It's Dennis at orangequant.com with another edition of Stat Trading. Today is Monday, January 6, 2020, and it is just about the closing bell here coming up. You won't hear it because I closed down my platform just now. And today's video is going to be about sample size and how big or how small it needs to be. That is, if you're a stat trader. And today I just found out something really interesting about stat trading, and I'm going to share that with you in a moment. But first, the disclaimers, and please take them seriously. Trading is risky. Risk no more than you can afford to lose. Do your own due diligence, and always use stop losses. Not mental stops, but hard stops. And here's the full hairball of the legal disclaimer. Please pause and read. Thank you. Now, before I get into this issue of sample size, like I said, I want to share with you something I discovered today. I did a search, I used a search engine, and I went out and I searched the term statistical trading, actually is what I searched for, statistical trading. And I found one lonesome guy out there who is doing a bit of this, but he's talking about it in a slightly different context. But at least there was one other. And I am proud to be in such a minority. So if you get on board with this statistical trading ahead of everybody else, you're probably going to do very, very well. And at this point, given what I just discovered with this search, I'm really expecting a much larger class than I thought I would have. And that class will be announced soon. Please hang on. Now, as you do any kind of trading, if you're doing any kind of statistical stuff on it, you're looking back and saying, well, this number of times this happened and therefore X is going to happen now. What you will hear from a lot of so-called wise heads out there is, your sample is too small. Well, probably not. Probably they don't know what they're talking about. And many of them love to brag about how far back their back tests go. And then when they run the actual trade and they lose money, they don't understand what happened, or they give some wild excuse for why it went wrong. So when they say to you, your sample's too small, ignore them. Just let them go on about their way losing money. Now I'm going to show you why your sample is not too small. Just hang on. Now before I show you some actual statistics, which I'm going to run for you here in a second, you want to realize that what you're doing here is you are trading in the present. You are not trading 10 years ago, and your horizon is nowhere near 10 years long. You're probably in here as a day trader or a swing trader for a few days or at most a few weeks. So big data is going to lie to you. Conditions change over time, and these days conditions change rather rapidly, as I am about to show you. Alrighty, here are some actual stats. This is US Steel, symbol X. And what you're looking at here, I'll explain it very briefly, is the simplest of possible algorithms being plotted. And they're being plotted on different averages. The top one is a 20-day moving average, the middle one is a 250-day moving average, and the bottom one is a 500-day moving average. And what's being plotted is, as I say, very simple. It is the day's range, in other words, from high to low, and how that changes over time. It's showing an average of that. So on the 20-day moving average, and this is an actual dollar amounts, you've got on US Steel 53.6 cents is the daily average. Or I should say the 20-day moving average is 53.6 cents. On the yearly, which is about 250 days, you're seeing 65.2 cents, which is a big difference in range. And if you reach back about 2 years, you're seeing almost exactly a $1 moving average range on the daily bar. So 53 cents to a buck, just based on the difference in moving averages. You talk about being able to screw up your little algorithm by using big data. This is the way to do it. And I didn't just pick on US Steel. I mean, I did it kind of randomly. Let me show you something else. Apple. How about Apple? Everybody likes to trade Apple. So here, let me get this set up right. Here is Apple, and bring it in view if I can manipulate this properly here. Okay, here's Apple, and Apple is ranging anywhere from $4.35 down to $3.57, and you got that bottom one, that 2-year average, $3.71, and that's the average daily range on those various moving average setups. Want more? Okay, here's eBay, and you can see a range between them from about 43 cents all the way up to 73 cents, depending on which moving average you're using. So this big data idea being floated about as being better than short-term data is just silly. And here's just one more to make the point. A whopping, what is that, about a $2 difference on Tesla there between the 20-day moving average and the 250? That's a lot. That's huge. Now, I gotta admit that there are situations where big data is relevant. But when you do backtesting and things like that, I wouldn't reach for big data. I'd try to accommodate the period that I'm in, the kind of the trend that I'm currently in. So like I say, I hope this was useful to you and helps guide you down the road. I'm Dennis at orangequant.com, wishing you and yours a good evening and a great trading week.